Our last speaker is Professor Jim Hawley, professor in the graduate business programs and co-director of our Elfenworks Center for the Study of Fiduciary Capitalism at St. Mary's. He's published widely in the area of corporate governance, including his influential book with Professor Williams, The Rise of Fiduciary Capitalism. Professor Hawley.
Thank you. I'm not going to take the role or the position of the last speaker and either try to summarize or even comment on what's gone before. Rather, I want to go off in a quite different direction to talk about the role of corporate governance, both briefly in the past and going forward. Corporate governance at its core deals with the rights of share owners over the assets they own and the alignment or attempted alignment of shareholder interests with the behavior of all too often self-interested management. Institutional owners own the vast majority of asset classes in the U.S. and in most other major investing nations. This has been new to most nations in the last 30 years and represents a real ownership revolution with very significant implications for the current crisis. Among the most important owners are, and I think you know this, public and private, the corporate pension funds, mutual funds, insurance companies, and some banks. Most of these are fiduciaries for investors, mostly investing for people's retirements in different forms, and pension fund beneficiaries. They have a clearly defined duty to the financial interests of the investors and their beneficiaries. This duty has been far, far too narrowly understood, both in practice as well as in the law. While corporate governance failures were not the primary cause of these crises we've been talking about, they were significant and often unintentional contributors. How? Overall, they massively failed to consider systemic risk. They failed to adequately consider sector and especially financial sector risk, as well as risk in related real estate markets and commodity investment risk. Let me highlight 9 failures very quickly. 1, in their search to do better than so-called benchmarks, increasingly institutional investors moved out of equities and corporate and government bonds into so-called alternative investments. This is a search for so-called alpha, which essentially meant beating returns available on most equity markets. They became major funding, in fact, the major funding suppliers to hedge funds, to the real estate industry, commodities, and private equity. 2, institutional investors also invested heavily in major banks, which in turn had private equity funds and sub-hedge funds, and in this sense they were doubly exposed. Mostly they accepted the notion that bankers knew their own self-interest to protect banks from failing. They did not look at the dangers from endogenous, that is, internal and systemic financial failure, which have occurred, as we've discovered here, with depressing consistently throughout the history of market economies. 3, both directly and indirectly, institutional investors sought and temporarily received higher returns in these sectors seeking alpha, while blind to what was actually going on in these highly leveraged investments. Leverage was the means to alpha. We are seeing, obviously, the reverse now. 4, while increasing recognition of corporate governance on the corporate governance front that, for example, the top 5 executive salaries in high return sectors were in many cases in the past years not related to returns, that is, the pay for performance principle was violated, institutional investors ultimately failed to rein in these salaries. There was no attention paid to those lower down but extraordinarily highly compensated in the short term, mostly important top traders who often took on risk which they neither understood, and importantly did not bear the consequences of. 5, thus the incentive problem that links incentives to sustainable long-term returns is core to the corporate governance aspects of financial crisis. The breadth, depth, and systemic risk aspects of this was not recognized even by those most active in corporate governance in the past 10 to 20 years. 6, institutional investors and corporate governance activists thought they could bring some element of influence over their investment on their own without any significant reliance on government supervision or regulation. In my view, this has proven a tragic illusion. 7, most but not all institutional investors accepted short-term corporate strategies in non-financial industries as well, such as the auto industry, and they failed in their role as universal owners who represent a cross-section of the whole economy. 8, most institutional owners accepted the analysis and assurance of the majority opinion in investing in academic worlds that the newly structured financial instruments, CDOs, certain kinds of derivatives and the like, and their massive growth was just fine, and most important, that the leverage behind the massive growth was manageable. They did not seek out minority views and make independent judgments. This was entirely off their radar screen. And finally, 9, even had institutional investors done some or even all of the above, they would have been blocked, at least in the US, by their inability to do this, in part, for example, by independent nomination of directors to firms. What might be sustainable finance in the future and going forward? 11 very quick suggestions for fiduciary institutional owners. Only 11. 1, greater transparency and disclosure mandated by law, regulatory, and market listing standards. 2, focus on and reward serious long-term performance. Do not reward short-term, as in quarterly performance, except minimally. 3, become involved in public policy issues that affect investors and beneficiaries, e.g. SEC reform, mandating clearinghouses for derivatives and other structured financial instruments, transparent hedge fund accounting, on-balance sheet accounting, that is, end of the shadow banking system, and mandate certain kinds of leverage limits. 4, strengthen corporate board accountability to investors, that is, majority voting, say on pay, nomination rights, and the like. 5, monitor outperforming companies and sectors. Develop systemic risk planning for all financial institutions. Ensure there is a separation of risk from product creation and distribution. 6, be clear what institutional owners can do and what they cannot do. This becomes, if it is necessary to be done, the role of government and, most importantly, international governmental standards, cooperation, supervision, and regulation. 6, this follows, obviously, coordinate globally with other institutional investors. 7, this may seem like a minor point, it is not. Do not rent your share voting rights, which has been a widespread phenomenon in the last few years. 8, reassure the basis for credit rating agencies. Restructure the credit for the basis for credit rating agency. That is, owner pools should pay for ratings. Eliminate those major conflicts of interests. 9, remunerate institutional owners, money managers for the long term. Again, minimize short-term reward. Consider banking more like a utility. Financialization of the economy should be limited. And finally, point 11, expand and deepen the meaning of fiduciary to encompass especially a focus on long-term for retirement funds of all different kinds. In sum, the principle should be that ownership should be seen as stewardship and the guiding principle of fiduciary obligation and corporate governance activities. Thank you.